As we look ahead to 2026, the market is shaped not only by valuations and earnings, but by structural forces. This video will explore 4 investment themes that feel distinct and relevant for the next year and beyond, especially for those looking for a strategic investment view rather than short-term trading. We'll focus on big-picture questions rather than specific predictions. First, why could defense and global conflict dynamics remain a structural theme? Second, how do healthcare and insurance intersect with aging populations and climate-linked health pressures? Third, why might energy stocks be attractive at a time when traditional ESG narratives are under stress? And fourth, what is the current state of real estate, especially REITs, and where might opportunity lie? Throughout, I will not be giving advice. Your decisions belong to you and your financial advisor, and past performance does not guarantee future returns. Why might global conflict and defense spending matter in 2026? If we scan the last decade's headlines, we see repeated geopolitical flashpoints. The conflict triggered by Russia's invasion of Ukraine, escalating tensions between the United States and multiple states, and persistent instability across parts of Africa and the Middle East. These are not isolated crises, but hints that global power dynamics are in flux. Analysts see defense budgets rising sharply as nations expand military readiness in response to economic competition, territorial disputes, and great power competition. Defense and security are no longer niche budget items. Governments are increasingly allocating a growing share of GDP to defense and related technologies. This rising baseline of spending creates structural revenue visibility for defense contractors, especially those involved in advanced munitions, aerospace systems, cybersecurity, and next-generation battlefield technologies. Another factor is the integration of artificial intelligence into defense ecosystems. AI can optimize targeting systems, enhance logistics, and power smart automation, and defense companies with AI-ready products can monetize both hardware and software advances. Examples of stocks that align with this theme include major US and European aerospace and defense firms. In Europe, companies like BAE Systems, Rheinmetall, Leonardo, and Saab have seen strong market performance linked to higher projected defense budgets. Stateside, firms such as Lockheed Martin, Northrop Grumman, and RTX continue to secure large defense contracts tied to modernization programs. None of the aforementioned rationales implies an endorsement of conflict. Instead, it acknowledges that when national defense spending rises, certain segments of industry experience durable demand. For long-term investors thinking in years and decades, these structural trends can be part of a broader portfolio conversation.
Trump said that he will propose the 2027 defense budget to be $1.5 trillion. Trump also called out defense companies, saying they need to prioritize defense production over share buybacks and dividend payments.
This has led to major U.S. defense stocks like Lockheed Martin, Northrop Grumman, and Raytheon rising in extended trading in New York after the announcement.
Why healthcare and insurance stand as interconnected growth areas. Healthcare and insurance stocks often travel together, not because they are identical, but because they respond to shared demographic and systemic pressures. One of the most unambiguous demographic trends of our era is population aging across developed economies. As populations age, demand for healthcare services expands, and the complexity of care tends to increase. At the same time, climate change introduces new stressors on public health: heat-related illness, vector-borne disease shifts, and chronic condition of exacerbation linked to environmental factors. Insurance companies sit at a unique intersection of these trends. They underwrite risk in sectors from health to property, and strong insurers typically maintain robust balance sheets with diversified revenue streams. While insurance is not a classic growth sector in the way early-stage tech can be, it can act as a stability anchor in a portfolio because of predictable cash flows and disciplined underwriting. Because healthcare expenditures and insurance underwriting are both tied to longevity and systemic risk, stocks in both spaces can capture growth without relying solely on macro expansion. Examples include large global insurers such as Allianz in Europe and Legal & General in the UK, which benefit from scale and balance sheet depth. In the healthcare space, firms that provide essential services or products to aging populations, ranging from pharmaceuticals to medical device makers and healthcare services, address needs that are unlikely to disappear. While aging populations bring complexity, they also generate sustained demand that markets have historically priced into long-term cash flows. Why energy stocks may regain strategic appeal. Energy is often spoken about in the context of ESG and transition narratives, but as we near 2030 targets, practical constraints such as cost pressures, infrastructure challenges, and unexpected geopolitical disruptions are reshaping how investors think about energy.
ESG stands for Environmental, Social, and Governance. You can think of it as an analysis framework to help measure and quantify the degree to which an organization is operating in a sustainable manner.
The assumption that renewable investments automatically outperform because of climate urgency has faced pushbacks when affordability and reliable supply are part of the picture. Energy costs in many markets remain elevated, partly because supply chains have been under pressure from conflict-related disruptions and export choke points. At the same time, global energy demand continues to rise, driven by traditional consumption and new sources such as data centers supporting AI and cloud infrastructure. The rapid growth of digital economies places structural demand on both power generation and transmission systems. This dynamic reframes energy stocks as not just transition plays, but as infrastructure and utility anchors. Traditional energy companies, midstream operators, and even some integrated utilities may benefit from persistent demand and pricing power when supply cannot keep pace with consumption. Examples of stocks under this theme include Enbridge on the Toronto Stock Exchange, EU-focused Kinder Morgan, and UK-based National Grid. Energy is not monolithic, and investors may find variation between renewables, traditional oil and gas, and utilities that blend reliability with long-term contracting. The key is understanding energy's central role in powering both established consumption and emerging digital infrastructure. What's going on with real estate, and why some REITs still make sense? The real estate sector has been under pressure since 2022, influenced by rising interest fees. Despite these macro headwinds, there are still pockets of opportunity when viewed through a thematic lens rather than a short-term trading frame. One structural shift is the return of office demand, as hybrid and mandated in-office days by some major businesses in London and New York. That creates rental growth for office properties in the right markets. Another structural driver is logistics, fueled by e-commerce and supply chain realignment since the pandemic. Healthcare-related property, such as medical office buildings and senior living facilities, aligns with the demographic trends discussed earlier. Examples include Prologis for logistics, Welltower and Ventas for healthcare, and finally Boston Properties for offices. If you want a deeper primer on how real estate investment trusts, REITs, work, and why they distribute income differently from typical corporations, you might check out our dedicated video on REITs in the description and in the above card. It's also worth noting that real estate investors who look beyond headline indexes can often find value in specific subsegments that align with long-term economic forces rather than short-term sentiment. These themes are opinionated and reflective of structural dynamics, not short-term calls. None are guaranteed to outperform in 2026, and none should be taken as individual investment advice. Always consider your risk tolerance, time horizon, and the guidance of a financial professional. Theme by theme, what we see is not randomness, but interconnected structural change stemming from geopolitics shaping defense demand, demographic forces influencing health and insurance needs, energy markets adjusting to real-world constraints, and real estate slowly responding to shifting work and consumption patterns. If you found this video useful, thank you for sticking with it. We're building a channel focused on finance that assumes intelligence and curiosity. If that resonates, please like the video and subscribe to the channel. Hopefully I'll see you in the next one.